After hitting all-time highs in August of 2020, the price of gold has been firmly in reverse. Just this month, the price has slipped back towards 1680, which are the worst levels since June of last year. It's a big week this week with interest rate decisions from central banks. Are we finally going to see the short to medium term fortunes of gold turning around?
Gary Rosenweck Associates still calling for $15,000 gold before this bull cycle is over, expecting a full turnaround in the second half of the year. Frustrated gold investors need to look at the gold to oil ratio when determining price reversals. This means that gold will stop falling when it becomes less expensive relative to oil. What needs to happen is for the ratio to move back to around 15 from the current levels in the upper 20s. Double Line CEO Jeffrey Gundlach is no longer just neutral on gold, saying that the precious metal is done falling after hitting a 10-month low on Monday. Gold's fair value is at $17.61 an ounce, he said, which gives the precious metal some room to the upside. Finally, for number one, we have Barry Gold CEO Mark Bristow saying that another spike in gold is coming. This headline comes from Bristow's keynote presentation from the world's largest mining conference, the PDAC, which was held virtually this year. Bristow said that there's an over-exuberance in the financial markets right now, with investors desperately piling into assets that don't have any real value. This kind of behavior led to a major crash in the past, and it will happen again, he said, adding that there's another spike in the gold price coming.
Okay, so are you saying that gold is, I guess, replaced by the market as an inflation hedge and there are better instruments out there?
Yes, exactly. And the fact that many people, received stimulus checks and things like that over the course of the last year, they took that money and they deployed it into different asset classes, things like Bitcoin, Ethereum, and chasing these other assets that are out there, whether it be stock indices. We talked about, some of these smaller stocks just going to unprecedented levels again. So it was really, money came into the market, it was chasing inflation, but it was chasing different ideas out there where normally the concentration would be held in like gold and silver.
And I think the performance of other financial markets here is clearly having an impact. If we look at stock markets, for example, just this month, again, we've seen all-time highs for the S&P 500 and the Dow Jones, the narrower US stock market index. So I think when we're seeing other markets gain and some positivity about an economic bounce back, that clearly does take the shine off gold.
The problem that I have with gold is that you had the mother of all,
yes,
it was the Super Bowl. It was it. And we got to what, 2,100 and some change.
Yeah.
Okay. So unless we have some new catalyst that could drive it at that rate, whatever it might be, it's possible that something happens. You have war, you have banning of currencies, you have perhaps maybe banning on the green energy guys go after mining and there's no mining. So then supply all of a sudden gets shut off, demand increases for gold, and you get the $2,500, $3,000 move. So I am optimistic there will be a recovery. I don't think we will make that new contract high, not this go around. I think it'll be a second. It's gonna be another multi-year catalyst to get us up to those record, the 2,500, 3,000 plus. The reality is that interest rates will stop going up. So interest rates are a big input cost for miners. The energy costs, second biggest cost for miners. Those will come down once you have like Saudi Arabia and OPEC boost the demand. Gold prices should naturally rise with the compression on economic data. So I think that second half of the year, I think is a great place for the miners. And I don't recommend throwing in the towel because too many people have ridden it lower. I think you'll get that recovery trade in the second half. So, keep your chin up if you're long the miners.
But investors want to know why the pressure on gold, Simon.
It's a market. There are different markets in gold. There are different players in gold. There are people who buy jewelry. I mean, I'm talking about jewelry manufacturers. There are miners. There are speculators, like in most markets. And all of these people have different ideas and different dynamic. The biggest investor, potential investor here, is the Western financial investor, who is could be exposed to dramatic depreciation of financial assets in real terms.
There's no reason for gold to be where it is right now or to sustain this level when you've got an additional $4 to $5 trillion that has been pumped into this market just in the U.S. alone. So somewhere along the road, this is going to turn, and it's going to turn pretty aggressively. Now, is there more to the downside? Again, I'd like to see that 1685, 87 level hold from a technical perspective, so we don't get more onboarding from technical traders to the downside. But, you know, maybe there's another 50, 75 bucks in it to the downside, but I don't think there's much more in the gold market on the downside, given what we've seen from the stimulus that's in the global economy right now.
For second half of 2021, how do you see gold playing out?
Okay, so the way I believe that the models that we have work are going to show that in the next quarter, you're going to see higher CPI data, record GDP data, and then after that, the comps year over year are going to compress, right? So how many people were shopping at Amazon last March versus this March? How many people were ordering, you know, pizza delivery last March when you couldn't go anywhere? That was your only option, to this March when restaurants are starting to open. So the comps are going to compress as we get more opening. The interest rates will start to compress with that economic data. At that point, we'll see the bottom in gold. So we're really optimistic on gold into the second half